A commodity is a good or service whose units are pretty much interchangeable. For example, when it comes to gold, an ounce of gold will equal an ounce of gold regardless of where it was produced or who produced it. The prices of commodities, things like oil, grains, and precious metals, do fluctuate over time. The price of a commodity is determined as a function of its market as a whole. Commodity prices of gold and silver are represented as prices in dollars per ounce. When looking at commodity prices, there are a few numbers presented that reveal the current state of the commodity. First is the current price per ounce. Then the change net is presented, which is how much the price of the good has increased or decreased since the prior report. This increase or decrease is also displayed as a percentage. Each day, a high and low price is reported as well. Since commodities are traded on exchanges, there is no one individual or entity that determines their prices. These exchanges are the ones that measure the published prices. Exchanges extrapolate prices from a sample size. Prices are determined by the average quantity of production of available data. CME, a financial marketplace, owns and operates 4 different exchanges: Chicago Mercantile Exchange, Chicago Board of Trade, New York Mercantile Exchange, and the Commodity Exchange. We will be using the numbers published by the COMEX when looking at today's commodity prices later in this video. Generally speaking, the prices of gold and silver can reveal what the current state of the economy is like. High gold and silver prices mean that the economy is not healthy. Investors will purchase sure-thing commodities like gold and silver as protection from an economic crisis or inflation. Investments in gold and silver are known as hedges, a type of investment made to offset negative progression in other investments like the stock market or inflation. On the other hand, if the prices of gold and silver are relatively low, the economy is doing well because investors are putting their money in other profitable investments like stocks, bonds, and real estate. If the economy is doing well, these investors have more confidence in these standard investment options that may return more or benefit them more than investing in gold and silver. Because of this, if gold and silver prices are relatively high, we can assume that people are being more cautious about where they put their money because of potential negative changes in the economy. During the Great Depression, the price of gold went from $20.67 an ounce in 1929 to $35 an ounce in 1934. During this time, people couldn't afford luxurious shopping and they had to be smart about their financial decisions so they could simply get by. But if gold and silver prices are low, there is less nervousness about the economy, and people are more likely to be spending more money in shops and stores for wants and desires rather than just needs. According to NASDAQ, the latest price of gold is $1,330.70, which is an increase of about $2.90 since the last report. And the latest price of silver is reported as $15.97, about a 6.4 cent increase. Both of these prices have been increasing over the last 6 months.